This is the class for CMA part 1, and we are going to discuss the measurement, valuation, disclosure, investment and short-term items. Today we'll discuss the statement of financial position, that is previously we called as balance sheet. Balance sheet, when we say, it's a balance between assets, liability and equity. Today our discussion is more about current assets, how current assets works. We'll start our discussion with accounts receivables, inventory fundamentals, inventory, how to do the methods, inventory measurement in financial statements. Either it is lower of cost or market, classification of investments, current investments, equity methods, and basic combination and consolidation of financial statements. In the last, we will see different type of expenses and liabilities. I'll start one by one. When we make a business sells some core activity. For example, if you are a shoe manufacturer, you are going to manufacture the shoes and you are going to sell them. When you go in the market is really competitive. It's not always possible to sell your things on cash, so you have to attract the market by giving them credit terms. Means you sell now and the money will come after certain time. So you are not going to receive immediate cash, but you will create accounts receivables. Receivables are your current assets. As quickly you will convert money, your receivables into cash. This is good for your operating cycles. So we are going to discuss accounts receivable. They are also called as trade receivable. These are the sales done on credit. Now, receivable should be separated into a current and non-current portion. Generally, receivables are for useful life less than 1 year. We classify them as current assets, but there are some receivables which is more than 1 year life. So that will be classified as non-current receivables. Current account receivables are reported in the balance sheet at NRV, that is net realizable value. What is net realizable value? You take the total value and you subtract any kind of provision, any kind of allowance, so you get the net realizable value. Net of allowance for uncollectible accounts, allowance for the sale return and billing adjustments. Non-current receivables are measured at net present value of the future cash flows, because current assets are those like current receivables are those which we are going to generate through our activities, and we are expected to convert them into cash as soon as possible basis. But long-term receivables, they are generally little complex in nature, so we want to see the present value or the future cash flows. Let's discuss some entries from an accounting point of view which is related to the receivables. First of all, when we sell and we don't get money but we create receivables, receivable is your asset. Asset normal balance is generally debit, so we debit accounts receivables, and every debit as per bookkeeping rule should have an equal credit. So we credit the sales account because this is an activity generated from a sale. We didn't receive cash, but we are expecting to receive, so we create an accounts receivable. This is the basic entry to recognize our sales. Suppose we get money from the sales, so this receivable is now finished. So the debit receivable will now finish with the credit, so credit receivable account, and whatever bank or cash we will receive, it will be debited. Sometimes it is very usual, for example, if you deal with 100 customers and 100 customers will not pay your money on time. If we are giving credit to 100 people, we should be prudent in knowing that 100 people will not give us our money back. There might be 5%, 10% people who will say, look, we cannot pay you. So technically these are called bad debts. These are bad debtors, bad receivables, who declared themselves that they are not able to give you money back. So we have to record it in our books. Bad debt expense, every expense has to be debited, and we have to credit allowance for doubtful debts, because we create provisions, liabilities in order to rationalize the future judgments, right? So what we are going to do is, first of all, we recognize the revenue. As I told you, account receivable will be debited and sales will be credited. When the sale will return, we will return the sale, and allowance for sale return will be credited. Moving forward, he says that how to put the allowance for uncollectible accounts and bad debts expense. As I told you, that when we sell on credit, based on our credit policy and our follow-up and collection energies, collection focused, if we have a very good credit department who gives credit to the customer after taking certain documents, like you should be 3 years old company, you should have 2 references from the market, that how you pay your suppliers. If I do all these credit checks and then I will give you a credit limit, then this is more highly it is more likely that I will not have a default. But if I just throw and sell, I have never done my homework, I don't know the buyers, so it will increase the risk related to the collections. That's why all big companies, they have a credit department. This department investigates the strength of a supplier or a customer, right? So he says, but as I told you, like if we deal with a lot of customers, we cannot say that everyone will pay us, so we have to put a provision or an allowance. It's an estimation, it's not an accurate figure, of course. We are anticipating that based on our judgment that 2%, 5% people will not pay us the money as we are selling goods on credit. So immediately we will put a provision. This provision, in the end of the year, we will see what is the actual situation. We will adjust with the actual amounts, right? So this is what is the concept of the provision. Collection in full of all account receivable is unlikely, so we put provision. He says bad debt expense recognized for the period, increase the allowance for uncollectible account. So as your bad debts are increasing, on the other hand, allowance for doubtful debt is also increasing. He says there are 2 methods to put value of bad debts. One is very simple. You can take the income statement. I can tell you, like if I'm the management and you are the CFO and you are asking me like how you see this year receivables, I'll say like let's take 5% of the total sales. This may be a formula, or maybe I can say 2% of all outstanding receivables. When I say 2% of account receivable, means I am following a balance sheet approach, because receivables will show in balance sheet. If I say 5% of the gross sales, I am taking income statement approach because I am taking figure from the income statement. So these are two only methods which we take, either it's a sale or either it will be a